I think it's perfect timing to start. And one more time, I'm going to say welcome. Welcome to TechBiz, brought to you by Eco Innovation Center. It is our custom every single Thursday at 5 p.m. West African time. We come online and we talk about key subjects that are supporting you, the entrepreneur, supporting your business with knowledge as you really strive for business growth. Interesting enough, this is the 17th episode, which means that the last 16 weeks, we brought you various topics going from, money, how to manage your money, how to manage branding, how to drive innovation within your company, any kind of topic that supports business advancement, including marketing, finance, sales, and so on. Now, if you missed any at all, or you want to catch up on any of the episodes, just go to www.ecoicenter.com/webinar. So all of the episodes are in there for you to catch up on. And this one as well, the presentation will be there on that page, and as well the video of this webinar. So don't worry. I know normally people just always ask in the chat box, can we have the presentation? Yes, it is there. It's going to be there on the website. So guys, you're welcome again. Ladies, guys, everyone is welcome. Hashtag TechBiz, hashtag Eco Innovation. So feel free to post your comments. You can see on the screen, we have all of our social media pages. You have the Facebook, the Twitter, the Instagram as well. We're always very keen to hear from you. And then we want to carry the conversation forward in social media. So should you want to have any comments, should you want to continue the conversation there, please feel free to post. But we always encourage as well, hashtag TechBiz, because that is what this platform is called, and that is what this platform is about. So during the webinar, again, as we've already started doing, in the chat box is where you comment, in the chat box is where you put your questions as well. And anytime during the conversation, you don't have to wait till the end to ask your question. Now, normally, I should tell you about Eco Innovation Center. If you can move to the next slide, about Eco Innovation Center. And I do this every single week. You know why? Because we want to demonstrate to you the area where we can provide support. That's what we're set up to do, supporting businesses that leverage two key enablers, innovation and technology. Because the focus is SMEs solve poverty within the continent. And that's why we want to support, and we continue to support SMEs. So whether you have an idea, incubation, business acceleration, you want to scale your business, you want to drive learning, whether learning for yourself or learning for your team, we're there to support you. If you're not sure, you just want to ask a question, please push us an email, info@ecoinnovationhub.com, and we're quite keen to support you and talk about what you need. And even if we are not able to provide, we're also keen to network you within our full community. Today, important day, we're talking about a technical subject. It's called about valuation. Uzoma, you're smiling, right? Valuation. In fact, I have my pen, my paper, my notebooks, because I'm going to be scribbling like no man's business, because this is such an important topic for companies beyond whether you want to sell your company or not. But it's just straightforward estimating the current worth of your company. It's really as straightforward as that. However, there's a framework, there are theories and there are processes towards it. And I'm so happy that we brought today a subject matter expert who himself, he does this, he's walked the journey, and he can share with us stories to support the framework, whether his own personal story or also maybe his clients as well. So Uzoma Nwagba, you are most welcome to TechBiz. You're mute.
Thank you very much.
There we go. All right, excellent, Uzoma. Before I'm going to hand over the reins to you, we're going to talk about the worth, how to evaluate the worth, whether you want to sell, whether you're looking for investors. For some of us, we're big enough to go to the stock market, whether you are keen to go that way. And, you just want to understand the intricacies of this. And that's what Uzoma is going to be doing. And as well, he has magnanimously offered to coach 2 entrepreneurs on this call. So he's going to be coaching 2 entrepreneurs on valuation of your business, valuation of your company. We're going to make that selection at the end of the conversation, and we will tell you how that selection will be done. Anyway, you know we do this almost every week anyway, and we're quite appreciative of you, Uzoma, and all of our speakers prior who have provided this kind of support to our participants. So I'm going to hand over to you. Every now and then I'm going to interrupt. Maybe not. I may interrupt you with some questions in case, you know, the questions are already coming in the chat box so that it's real time, but we're all ears and keen to hear you.
Thank you very much, Doja. Welcome, everyone. This is a very exciting opportunity for me to share something a little bit about valuation. This is a pretty complex topic, so my biggest job here is to oversimplify. My goal is that we at least achieve an understanding of the frameworks and the tools that we may need to then look at your business in a different light. Doja, I think the sharing screen might actually be working now, so let's just test it. Does it work?
Okay, let's do that.
Can you see the screen?
Tito, can you stop share? Okay, you go ahead and share.
Okay, let me try. Boom. Okay, now let me see. 1, 2, 3. Okay, just hold on. Okay, do you see me at my screen?
Not yet, we see you.
Oh, you see me, okay. Let's try that one more time. Oh, the admin has disabled screen share for the meeting, but
Tito, can you fix that quickly, please?
otherwise we let's proceed with the just project, and then we'll go with the plan.
All right, let's do that then.
Okay, hi everybody again. My name is Uzoma Agba. Just next slide. I just wanted to get a little bit of the introductions out of the way so that you have a bit of an idea of who I am, where I'm coming from, and some of the experiences that I will be relaying to you on this session. I spent my past life both in finance and tech. I used to be an analyst at an investment bank, Goldman in New York. I also worked as a product manager at Microsoft, had an MBA, and eventually worked in private equity. And in that role, my primary function was to look at businesses and make a call as to whether or not to invest. So I've had quite a lot of cycles looking at both technology businesses, product businesses, sales, people who are into FMCG, financial services, different businesses at various scales, seeking to understand whether or not we can is a good investment. And today I work as a Chief Operating Officer of a government project, and I do passive investments on the side. So what I'm hoping to achieve today, next slide, is to talk a bit about what it takes. Next slide, please. What it takes to value a company. And the first question is, why do you even bother valuing a company? What is the reason for valuing a company? Why do you care? And in the world of finance, there is a big F word, and it's not the word that you might be thinking. It's fundraising because you're trying to raise money. So you are trying to raise money either by selling a piece of your business or selling all of your business. And most companies, as a matter of growth, as a matter of going to the next phase of their operations, you want to raise a little bit of capital to fund your operations, to hire more staff, build your product, invest in research, expand your marketing, things of that nature. And my goal today is to oversimplify the concept of valuation. So I'm starting from the very basics. And so you're either trying to sell your company, all of it, and just exit, or you are trying to sell a little bit of your company. In either scenario, next slide, there's a fundamental question when you're raising funding. And that fundamental question is, what does it have to do with relationships? And to think about going into raising money, raising capital, most people stop and look at their business and look at their value and look at what they want to get out of raising their capital. So that means you say, I want to make 200 million naira. I want to make 200 million naira from this business. Or I want to exit the business and I want to go and do something else. I want to start something new. Or I want to raise 10 million naira to do more marketing and to expand the team or go into a new market. Or I want to raise 100,000 naira to buy more material so that I can make more clothing for my fashion line. Whatever the reason is, what most people do is that they look at it from the perspective of what they want. But as somebody who is active in investing, that is a big mistake that a lot of entrepreneurs make. They do not look at it from what the investor wants, the person that you're taking money from. So the quick question I'm asking here is, what does valuation have to do with relationships? And for those of you who are either married or dating or in relationships, you invest a lot of time in your personal relationships trying to figure out, what does my partner want? What do women want? There are lots and lots of books for men about what women want. There are lots of movies about what women want. There is Think Like a Man for women, trying to figure out what women want, trying to get into their heads, trying to understand what they do. Ask your fellow guys, ask your fellow girls. But the same idea works when you are trying to raise capital. You have to get in the head of an investor. And so this talk today will be focusing quite a bit on making sure that you are valuing your company in a way that you can actually meet your goals, which is to raise the capital you need, but also to protect your interest in your business. Next slide, please. So the first fundamental question is the big question of valuation. How much is a company worth? How much is a company worth? How much is my company worth today? And how much will my company be worth in the future? And I call this the big jump question, which is why you can see it's a question that knocks you out. And that is because there's no perfect science for valuing a business. It's a lot of perception and a lot of belief in the sort of intrinsic value and what the future will be. The hardest part of valuing a business is being able to tell the future. Let me give you an example. I had worked with a company, an entrepreneur that was trying to set up a network of schools. And today they have one branch. It's somewhere in Lagos. They have an exchange program. It's not even a full school yet, but they have students, maybe about 50 or so. It's almost sort of like a holiday preparatory session. They teach them engineering and math and science and coding, and they want to expand that to a proper school. And this guy believes that in the next 5 years, this will be a chain of schools, and this idea is so valuable. But the question is, how does an investor see you when you say, I want to raise 300 million naira to grow my branches, to buy land, to open up several network schools in different states, to equip the schools, to train the teachers? How does an investor see that business? And there is the business today, which is that you're building in Yaba or wherever with your 17 computers and 300 students paying, I don't know, 300,000 naira a year. And there is a vision that you have for the future, which is 7 schools in 8 states, or 7 schools in 7 states, and each one with 1,000 students. How do you marry that reality today to what you have for the future? And how do you make those come together to be able to estimate the worth of the business? Because when an investor is trying to invest in your business, they are buying into the whole business, both for today and for the future. And so they are saying you have X number, you have a building and you have 17 computers. What's the value of that? Then you have an idea that can translate to 1,000, 7 schools, 1,000 students each. What's the value of that? So when you say invest in me today, what am I buying? And I think that's a big fundamental question of valuation. So you can see that it's a lot of it's a bit of an art, but there's also a lot of science to it. So what I hope to achieve today is to take you through the science of it and to do it from the head of an investor, and for you to understand how to look at your business when you're trying to estimate its value and estimate its worth. Next slide, please. And so, worth versus price. People say, and that was one of the questions that were asked in preparation for this session. They said, what is the worth of my business and what is the price of my business? Now, there is a worth of your business, which is how much is this business going to be worth over its lifetime? What is the real value of my network of schools over its lifetime? And then there is a price, which is the perception of that value. And what I mean by that is there is a truth that, quite frankly, not many people can know, because you don't know whether you will be able to execute the strategy properly to expand to your 7 schools. You don't know whether you'll be able to find the right teachers to be able to staff those schools. You don't know whether the price at which the price of the education is something that 1,000 people in 7 states can afford. So whether you can have students to meet those needs. You don't know many things. You don't know. Think of a fashion business. You don't know whether or not the price of the dollar would go higher and fabric becomes more expensive to the point where many people can't afford your clothes anymore. Think of a tech startup. You don't really know whether there's a good product market fit. What you just, the app or the platform that you developed, you are only developing it and hoping that people will use it, or you are developing it because you believe that there is already enough demand for it, but you don't really know. So there's a lot of uncertainty, but there is a truth as to what will happen. And that is the fundamental worth of that business. But nobody really actually really knows what that business is worth, because you don't know exactly how everything will pan out. But somebody's trying to give you money, and there must be a valuation. There must be a value that is ascribed to it. So you people must land on something. Now there's a price, and the price is a perception. So you think, man, my idea is it's worth $50 million. That's the value of this thing right now. So if you're coming in now, you are coming into a $50 million business. You just don't know it yet. And the investor is like, that's nonsense. your idea, as far as I'm concerned, you just have that building in Yaba. In fact, it doesn't belong to you. And you have 18 computers and 300 students, and they cycle through over time. And all the school fees that you're making in 1 year is not up to $500,000. So you can't tell me that this business is worth $50 million. So my point is that the worth of a business is fundamental. There's a truth to the worth of a business. Most people don't really know. But there's a price that is really a perception. And like I say now wash, price now wash, in the sense that it's really about a perception of value. And it doesn't just apply to business, it applies to everything. When I see when you make a dress and you tell me that dress is 5K or 10K, it's not because you added all the fabric you bought and the machine and the thread that you used and the fraction of the time you spent on the machine sewing it compared to the value of the machine. You just have a perception of the value that it's worth 10K. At least it will cover your cost and a profit. That's the same way businesses work. So your goal as an entrepreneur when you are valuing your business is that you want to make sure that the price that you agree with an investor, that is the value that you agree with an investor, must be greater than or equal to what that business is truly worth. Remember that true worth, you still don't, nobody actually really knows, but you have a way, which is what we're trying to achieve today, to give you tools to at least land on something close enough to what the true worth of your business is. But you must make sure that when you are going to an investor, that the price that you are agreeing with that investor must be greater or equal to the true worth. So if after we go through this valuation exercise, we learn that your business today is worth 50 million naira, and that is including the idea, the potential that it has, how much it's going to produce, how much sales is going to make, the market that is going to capture. That if somebody bought that business right now, that business will be worth 50 million naira in 5 years, or 50 million naira over the long term. Now, you have to be able to land on that figure. And you make sure that if somebody is trying to invest in you today, that the valuation of that business cannot be less than 50 million naira. It can be 100, which is if we are lucky. So I think that's the fundamental we're trying to achieve here. So next, please move on to the next.
I have a quick question, Uzoma, which is that, you're talking, of course, about future sales, because future sales is extremely critical. But you and I know that the buyer, the investor, is trying to buy at the lowest price possible, while you, the seller, is trying to sell at the highest price possible. How do you then estimate that future sales?
Excellent. So the future sales, because the future sale is really about your current performance and also a number of things, including the size of the market. And I'll give you an example. If you are a technology startup and you are making a revenue of 5 million naira a month, let's say that you built a social application that people sign up to meet people, and you're making revenue of 5 million naira a month, and that means that your revenues are growing at, say, 10% every month. So next month, 5.5 million. The month after that, 5.5 million plus 550,000 naira, and so on and so forth. So now there's a projection as to how much you're going to make in sales over the long period of time. Usually an investor has a time frame that they are looking to exit their investment. So they're saying that I want to understand how much they'll make in sales in the next 5 years. And then based on that, it is they evaluate what's the value of that 5 years worth of sales. And I'm oversimplifying it because it's actually not because you have your costs as well, and I'll talk about that in a second. But what is the value of that over 5 years? And then they do a bit of discounting till today. So where you start getting into a debate is, are you going to grow at 5% per month truly? Or are you going to grow at 10% per month, which is what you might believe, while the investor might say, no, this application, it only targets people who have smartphones, and most of them are in Lagos. The market is capped. Many people are religious. They don't really believe in meeting people online, especially for dating or whatever. So not many people will use the application. So your projection of your customers growing from 500 today to 550 to 550 plus 55, 1005, and so on, will not pan out like that. At some point, it will stop growing that fast. So both parties would usually do their homework and have a point of view as to how your business is going to grow, and therefore what is the value of this business over this time frame. So how do you determine that you don't get the worst deal? Then the first thing you do is that you want to look at what is it that is your own intrinsic value and intrinsic business today, and where do you cut it off? What is your minimum acceptable price? And then you get into a negotiation. So negotiations almost always end up in a negotiation. That's the most important thing to note. So could you double click twice? Just click twice, because I think the animations here didn't exactly. One more. So you need evaluation, because when you sell equity in a business to an outside investor, like an angel investor or whoever, the investor is giving you money for a piece of your business. I think this is probably fairly straightforward. But also, when they are giving you money for a piece of their business, they want to own as much of it as possible. So you have to have a sense as to what the value is today for you to know how much of the business that money they're going to give you will be worth. Please, next slide. Next, please. Now, the first rule of business valuation is, because valuation is about your word against, it's a little bit of your word against my word, with a scientific way of arriving at both. Each person has their point of view and the methodologies that they go through. At the end of the day, value of a business is, for the purpose of investment, is what you and the investor have agreed is the price of the business. And let me just give you a bit of a tale, because I'm trying to get in, now going to get into the fundamentals on how valuation works, and we'll pick sample businesses to give examples. So, a tale of jeans. If you are wearing a pair of jeans, and this is a question to the group, I would like to see the people's answers on the chat. It's probably a simple question. If you have a pair of jeans you are wearing that you have today, and then immediately somebody slides $100 bill into the pair of jeans. So you have a pair of jeans, it's in a nylon bag, it's worth $30. Somebody slides a $100 bill and folds the jeans and puts it in a nylon bag and hands it to you again. What is the value of that pair of jeans right now, as it is, the whole package? Just type your answer. Do we see an answer? Let me see.
Not yet. $130.
Okay, I'll take Victor. Yeah, so $130. Next slide, please. The same idea applies to the principle of valuing a company. Now, and I'm going to just get into the fundamentals of valuation, because a lot of times valuation is a very technical subject, but it's not complex. It's just that there are just some basic things you need to understand. One, there's a value of your business today, the genes. There is the money that the investor is putting into the business. Usually it's the money that you say you want. You are looking for a certain amount of money. I need $100 to do more marketing, or I need 100 million naira to do more marketing, or I need 50 million naira to hire more developers. I need, 500,000 naira to buy more fabric. Whatever that is, there is an investment amount that is going into that business. And the post-money valuation of that business is the genes plus the investment amount. Just keep these tools at the back of your mind, because we'll come back to it in a second. So this is a fundamental valuation equation. That's the money of the value of the business plus how much the investor puts in. It becomes the new value of the business after that. But now back to my point about thinking like a man, thinking like a woman, thinking like an investor in this case. What people don't think about as entrepreneurs is that they don't go into the head of the investor. You also need to get into the head of the investor to ask the question, what are the things that the investor is looking at? One of the things that they're looking at is the duration of time. You don't care, you just want your investment now and continue your business. But the investor is trying to make a return. And they're trying to make a return over a specific period of time. Because if I give you $100,000 today, and you give me, and I will get $300,000 in 3 years, it is better than getting $300,000 in 5 years. It's better than getting $300,000 in 50 years. But then I'll be old and gray. What am I doing with $300,000 at that time? So there is just a principle of valuation that for you to get into, to do valuation properly for your business and raise the capital that you need, you also want to think about what the investor cares about. And those are the things at the bottom. The duration of time that they are investing in, the annual return. And what I mean by annual return is that when an investor goes into a business and tries to put money, they have an amount of time they want to stay in and they want to get out. They also have how much in return they want to make at that time. But usually they try to annualize it. What I mean by that is they wouldn't say, preferably, an investor wouldn't say, I put in money today and I get it in 5 years without anything on the way. An investor would think of their return in terms of an annualized basis. They would think about, what is this return going to be on an annual basis? So if I put in $100,000 today and I make $500,000 in 5 years, I know that it is 5 times my money in 5 years, but it's actually easier for me to think about it as a 30% increment every year, so to speak. Because the 30% or 40% increase every year, because my 100,000 becomes 130,000, and then 130,000 becomes 130,000 plus 30%, and still hits me and lands me at that answer. So a lot of investors think of IRR. And IRR is just really the internal rate of return. How much does my business investment grow in percentage terms every year? Even if I realize all the money, even if I get the money out in 5 years, I want to know how it's growing every year. And then there's a concept of exit multiple. Exit multiple is when I get to the point of exiting, there is a multiple that I'm looking at or making on my investments, and I want to be able to know that now. And then exit valuation obviously is a big one, because that is the value at which you sell the business. So I'm saying this to say that if you think about valuation and you don't think about these things, you might end up not valuing your company correctly, and worst thing, you might end up not even making the money that you need. I'm very eager to give an example, so I'm just going to share my screen, and I'll turn off the video now. So please click next slide.
Uzoma, you can try to share your screen now, because now you're a co-host and you have the same rights.
Okay, let me see. Let me see. That might work. Okay. It's still not working, but I'll just share the whiteboard. That's fine. So can you see the whiteboard?
It's coming up. There we go. Yep. Thank you.
Okay. Can you see my writing?
Yes.
Okay. Excellent.
I hope everyone can see the writing. Please, if you cannot, please just type in no, but I believe that most people can. Okay. Well, we're already seeing yeses. Go ahead.
Okay. Excellent. So an investor looks at investments in a time horizon: year 1, year 2, year 3, year 4, year 5. I'll just stop at year 3 for now. And so the example that I wanted to give you was that when an investor looks at your business, they have an end in mind. Your business today is Ade and Sons, and you are making, let's say that you are a tech startup and you have an application. Now, there is an investor that you're trying to raise money from. That investor already has done their work and has a point of view as to how much it is that your business will be worth in 3 years. Let's say that they want to exit this business in year 3. They don't want to wait this long. So they're just sort of going to exit business in year 3. So they have a point of view as to how much your business will be worth in 3 years. Let's say that your revenue, your sales are, let's say your sales are 10 million naira a year. And the investor believes that you are going to be earning sales in the next 3 years. Your sales will be 40 million naira per year. That is, in the year 2023, your annual sales will be at 40 million naira. You would have grown by that much. Then that means that they also want to make a rate of return. Let's say that they want to make a rate of return of, or for argument's sake, let me even make the number simpler. Let's say that they believe that in 3 years, you're going to be making 50 million naira a year. And what that means is that they want to make a rate of return of 100%. That means that every year they want their money to double. Remember that they haven't told you haven't agreed on the valuation yet. This is what the question is. What is the value today? This is your sales, 10 million a year. This is your sales again, 10 million, 50 million a year in 3 years. But they want to understand, what should we value your business today? And remember, your value of your business is not sales. Now they have a point of view that their annual return is 100%. They want to make 100% every year. They want the value of their business, their investment to grow 100% every year. So what would happen is that they would say, okay, 50 million naira is the value of the sales of the business. And that means that if they want to make 100% every year, it means that they have a sales multiple. There's an exit multiple that they use. And these are usually, most businesses have a specific exit multiple. And what that means is that there's a multiple on sales that they use to value the business. And that means that they would say that the value of that business is the sales amount times a multiple. And that multiple, let's say that is the industry, the tech industry, the multiple of sales is 3 times sales. It means that at any point in time, the value of a business is 3 times the sales figure or sales amount of that business in a year. Now, that means that in 3 years, they're saying the business will be worth 150 million naira. But they want to make 100% every year. That means that for this to be worth 150 million naira in year 3, it means that in year 2, it should be worth 75 million naira. Why will it be worth 75 million naira? It will worth 75 million naira because between year 2 and year 3, this business should have grown 100%. So they are saying that the value of this business will be worth 150 million naira in 3 years, and I want to make a return of 100% every year. That means that the value of the business will be worth 75 million naira in 2 years, in year 2, because it has to grow 100% in year 3. So my question to the group is, if the business is worth 150 million naira in year 3 and 75 million naira in year 2 because it grows at 100%, because the investment goes 100%, then what is the value of the business in year 1? $37.5. Thank you very much. So 37.5 million. So 37.5 million is the value of the business in year 1. And that is how the investment will come to you and say, well, I see your business. I see you're making sales of 10 million naira a year, but I'm following my projections, and it's a bit of a complex way of looking at evaluation, because they then look at what is the industry you're playing in, what is the size of the competition, how much can you really sell, and they do a bit of research. And then, so this number is not exactly abracadabra. It's just that we don't have enough time for me to tell you how they estimate your sales in 3 years. And remember that even that is still an opinion. It's not a statement of fact. It's just an informed guess. So your business is worth 37.5 million naira in year 1. So they come to you and say, well, thank you, your sales are 10 million naira today. That's great. But your business, as we project, you'll be selling at 50 million naira in year 3. Your business will be worth 150 million naira by then. And therefore, our proposed valuation to you for year 1 is for right now is 37.5 million. Then you say to them, oh, I have sales of 10 million naira. Okay, thank you. They ask you, how much are you looking for? You would say, I'm looking for another 10 million naira to grow my business. I'm looking for 10 million naira investment. So what that then means is that the percentage of the company that they will take in your business, if you accept this valuation of 37.5 million, would be the 10 million naira that you put in your business, 10 million naira, over the 37.5 million naira that is the value of the business. And that would come to a little over 35, 36%. So the idea, what I'm trying to say here is that for you to value a business, you have to have a sense for what the future would look like. And you have to have a point of view as to what that business will be worth in that time. And then subsequent to that, you'll be able to ask yourself, what is it that your investor how are they coming up and how are they thinking about the value of your business as well? You don't have to accept what the investor says, but you have to be very clear as to your point of view, because you are always going to land in a negotiation on valuation. And in that negotiation, you express what you think it's worth, they come back to you what you think is worth, and then you agree. Once you agree on that number, in this case being 37.5 million, once you agree on the number, then you you would take the amount that you want, and they would take that percentage of your business. And that's how valuation would work. So 10 over 37.5%, I just want to get the precise number. I know it's a little over 35%. And that is the equity stake in your business that they will take. Now, what that equity stake, if this pans out the way that they are looking at, 37% of this business in 5 years of 150 million naira will give them exactly 100% return every year. And that's how they would look at valuation. Could you please put the slides back up? Okay. Just take me to next slide. Next slide.
Before you leave here, Uzoma, just to ask you about this pre-revenue valuation, because someone is already asking that for a fintech startup, it's a bit of a challenge to actually calculate the pre-revenue valuation. I mean, what's your take there? How can that be done?
Okay, so it's actually pre-money valuation, which means that you don't have to have been making revenue, just and the money in this case is before the investment money comes in. What is the value of the company? So not necessarily the revenue. I gave you an example of a business that had revenue, but you can also have a business that doesn't have revenue, in which case what happens is that you are using projected revenues.
Correct.
That means you have a point of view as to how much you will make every year over the next 5 years. And to make it very simple, let's just assume that your tech startup, you have an app. Everybody on the app is paying $2. That's, I don't know how much that is now. That is 880 naira. And everybody's paying $2 a year, 880 naira. And your business is really driven by the number of customers that you have every year. Now, you will have a point of view that in year one, I'm going to have 5,000 customers. And in year two, I'm going to double that to 10,000 customers. So you are saying that your 880 naira, that comes to about 4.4 million naira that you are going to sell, you're going to make in sales that year. And then in next year, 8.8 million, because you think you have 10,000. And then you believe you're going to grow exponentially that year three, you're going to have 30,000 customers. So my question to you is, I think somebody asked the question, and I'll come to that. You're talking about paying customers. So if you have that point of view, but you are not yet making sales, that's okay. People value ideas, but that idea has to have a worth, and there must be a way to quantify that worth. And so what most entrepreneurs don't understand is that they don't spend their time trying to quantify what the worth of that business is, even if it's an idea, to have a point of view as to how the market will receive this idea. How many customers am I going to have? How much are they going to pay? And how much money am I going to make on this business? If I take away my expenses, etc., how much am I looking at in what is essential? I'm oversimplifying this concept, but what is essentially cash flow? And that is a real worth of your business over time. So even if you've not made 1 naira in sales, you can still raise money. In fact, a lot of people do that. In fact, most businesses actually, of course, you have to raise money to even start. But you are raising money on the basis of what you are going to make. And so what I'm trying to show here is, and I'm going to just run through this quickly in about 30 seconds. There are many factors that investors will consider. The size of their markets, what's the size of a company, what are the projections over the next 5 years. That's what I just shared with you. Where there's intellectual property, that makes your business very valuable, very, very valuable. I had looked at a company, a biotech company actually, that was doing they were doing automated DNA sampling. Now it's common. There's even a popular company called 54 Gene, but they had a DNA sampling that was to take just a piece of your DNA and test for susceptibility to diseases. So if I take a piece of your DNA, a piece of your saliva, and analyze your DNA, I can tell whether you are likely to have cancer, whether you're likely to have diabetes, whether you are likely to have heart disease, and so on and so forth. And so that startup, we did some work. I did some work with the company, just trying to help them to think about the value. But the IP, the intellectual property on that was so valuable. And a lot of things add to the value of your business. I think that was valued probably at close to $3 or $4 million. And I even thought that was too little if that thing worked. It turned out there were hitches on it, so it didn't quite pan out. But the idea and intellectual property alone was worth so much money. The team is a big part because it helps to determine your ability to execute. Obviously, the product you're selling, please, next slide, to know whether you can make it and penetrate the market that you're trying to reach. They want to know as well, please continue, how much traction you've made. So even though obviously your company is more valuable if you've done something, as opposed to if it's just an idea. If you've sold a product, if you've built a product, if you have paying customers, if you've proven that the model works, then you actually have a more valuable company. If you are a food company as well, saying I'm going to be making dried potatoes, it's an idea. It can be on a PowerPoint slide, but until you're actually doing that, it's not as valuable as the idea. So, and even how much you've invested and time that gone in, because that even fundamentally helps to give your investors confidence that you are in this for the long haul. And of course, how far the state of the business is the competition, because if you are building a business where there is very little competition, then your chances of meeting those projections are very high. Next slide, please. I'm trying to get through it a bit quicker because I know that we are running out of time. And just skip this because we've talked about it. I wanted to just get into specific examples. So valuation methods. The first method of valuation, and I'll just talk about 3 methods that are the most common for small businesses. And the first is comparables. The first is comparable businesses, that is businesses in your industry that have raised capital. And the idea here, sorry, please go back. The reason for this thinking is a principle that over large amounts of data and large amounts of trials, there's always a reversion. There usually is a reversion to the truth. Think of it like the stock market. People say that nobody seems to know exactly what the dollar is worth, right? I mean, no, sorry, not the stock market. I mean the exchange, the FX market. Nobody seems to know exactly what the dollar is worth. But if you trade over a long period of time, where people are demanding and supplying, buy dollars, sell dollars, the price will somehow reverse or gravitate towards the true price of the dollar. Because if it is overpriced, if the dollar is supposed to be, let's say the true price of the dollar is 350 naira to a dollar. If the market had fixed it at 380, let's say the BDCs, Bureau de Change, have fixed it at 380 or at 400, at some point, there will be so little demand for the dollar that the price will have to drop. Not enough people will be demanding it, that the price will drop. And if it then reverses to the mean, let's say to that 350, that's the real price, and then continues to go down because people are still not demanding it enough. Let's say that they just hoarded, they held their demand and are not purchasing, and it drops below 350. At some point, people's needs will outweigh them. They will need to travel. They will need to pay school fees abroad. They will need to buy dollars. So they'll go back to the market and say, I want to buy dollars. And as demand increases, the price goes up back to that 350. So the same idea applies to market comparables. The principle of market comparables is that for a certain type of business, in a certain type of industry, in a certain type of market, if you have enough buying and selling on that business, I'm not talking about buying the product, I mean enough investment in and out on that type of business, of those types of businesses, at some point we'll really know the true worth of let's use e-commerce, for example, an e-commerce business. So the comparables model just says that if I am in a particular industry, let's say e-commerce, I want to be able to understand a lot of the sales of e-commerce businesses or investments in e-commerce businesses that have happened in my environment, and see at what multiple of their sales, for example, and it doesn't have to be sales, you can take multiple of their cash flow or multiple of their profit. But at what multiple of their sales is the example here that investment was. So I use this example. Your business is the one on the right, and there's a comparable business in the middle on the middle column. And that business is in e-commerce, you're in e-commerce as well. The business is in general merchandise, you're in household, which is not too far from general merchandise. There's an experienced founder and two new people on the team. You are first-time founders, but just one experienced person. So you're still not too far off. You are both in Lagos, so it's the same customers, the same markets. Your order sizes are not largely different. You are selling business to business, so you're not even targeting like Jumia, targeting consumers. I say, well, consumer business is so hard. You have to sell, you have to market, buy billboards, buy TV ads, do logistics. It's just businesses to businesses, so all you need just a few customers. You are kind of both in early stages, and the revenue of the business that has raised money is $25 million per annum. And you are now, 25 million naira per annum, sorry, and you are making 10 million naira per annum today. Obviously, if that business raised money at a valuation of 100 million naira, which is 4 times its revenue, that means the investors that have put money in that business agreed that business, even though it's making 25 million naira per annum, the long-term value and the value of the business and its potential over the next 5 years and perpetuity is 100 million naira. And so they value it at 4 times its sales. You can then say that my own business is also valued at 4 times its sales because the investments are similar, because the businesses are similar. And so my business will be valued at 4 times 10.8 million naira, which is 43.2 million naira. Now, there are drawbacks to this, and I'm sure some of the audience has already started noticing the drawbacks to this model. First is, where the heck am I going to find all the figures about investments that have happened in my space? If we were a bigger industry, and if it was a market that was not like ours, where access to information is a lot higher, then, or if it was a publicly traded company, you'll be able to get that. And quite frankly, on the stock exchange, you'll be surprised how many businesses look like your own that are listed on the stock exchange. And it may not, they'll be much bigger, most likely, but they are playing in the same industry and they're targeting roughly the same markets. So that's even a good place to start, to go to the Nigerian Stock Exchange, because those figures are fairly public. And you try to figure out what is the market value or the value of those businesses vis-a-vis their current sales or their current profitability. Now I'm oversimplifying this because sometimes the markets are in themselves irrational, so it may not necessarily actually be right. But that's a good place to start to even get a sense as to, it is my e-commerce business. What are the e-commerce businesses trading or in the public market? Let's go to the next one. Just skip next. Number 2, we just have this and we have one more and then we will end. The VC method, this one is a little bit more, real, more relevant to our market. And that's because, again, at the end of the day, fundamentally, valuation is a negotiation matter. There is no objective truth to valuation, but there are tools that help you get close enough to the truth. But at the end of the day, you land on a number with the person that's trying to invest in your business. And you make sure that the price or the valuation you agree must be less than or equal to your belief in the true worth of the business. Must be greater than or equal to. So in this case, I'll give you an example. And this is a quick and dirty way that people go about valuation, and they call it the VC method. So you have your business. You know the amount of money you want to be invested in your business to run your business. Let's say you are an entrepreneur that is doing logistics. You bought bikes. You're sort of setting up customers. You've hired your riders. You've trained them. You've invested, 20 million naira. But now you need to scale up. You need to advertise. You need to buy more bikes. You need to invest in training. You need to buy coolers or containers because you want to start delivering fresh food. So
you need 30 million naira. So you have to, first of all, start with what is the money amount that I need. Of course, that's why you're doing valuation in the first place, because you're trying to raise money. So 30 million naira is what I need, and I need it for the next 18 months of operation. You understand how much the investor wants to invest. So this wants to get in the business. This is typical for when you have an investor that is already ready with their cash in hand. So it's not let's wait and come back. So you get into this negotiation and the investor says, you know what, I can give you 30 million naira, but I want 20% in your business. The real work in this VC method is in that step 2. Everything else is just mathematics. And the step 2 is that negotiation where you have a point of view about how much you should be giving away in your business for that amount of money. Now, it helps, obviously, if you have a sense for the value of your business. And I think the last method is what will help you clarify that, the value of a business. And that could be one of two things. Some people just look at the assets of the business and say, you know what, all the bikes that I bought, all of them, I have 50 bikes. Each of them is worth 400,000 naira. And so my 50 bikes are worth 20 million naira. In addition to that, I have an idea, and I have staffing, and I have a team that is driving this operation, and this is the worth of my team. Let's say that you put a worth of the team at another 10 million. That's 30 million. So you have a point of view. Some people just look at their assets and then put a premium on their assets to say, now me as the driver and the visionary of this thing, my idea and my intellect and my skill to navigate this business environment is worth another 30. And so my value of the business is 60 million. This is the number that I feel comfortable with. But you have to land on that number and then get into a negotiation with the investor. So when you agree with the investor that, you know what, this 30 million you're trying to give me, I'm going to give it to you for 20% of the business. Then the rest of this is mathematics. If the investor comes and says 30% of the business and you don't agree and then you sort of negotiate and land on 20%, then no problem. Maybe you wanted it to be 15, but you land on 20, no problem. Then you negotiate down to 20. Then the valuation from there is really just how much that investor is putting in your business divided by 20% ownership stake that they will get after investing in your business. And bear in mind that when they are investing 30 million naira, that 30 million naira is worth 20% of the business. So obviously, you gross that number up to say, if 30 million naira is worth 20% of my business, then what is 100% of my business? And that 100% of their business is 150 million naira. But that is the post-money valuation. That is the valuation of the money of the business after the 30 million naira has come in. So of course, the valuation of the business before the 30 million naira has come in would be 150 million naira minus 30 million, which is 120 million naira. So the VC method really depends on, one, a ready investor, an amount that you are looking to raise from the investor, and the percentage ownership that you have agreed. The very last one, please just go very last one, and I'll just spend the next 2 minutes on that. The very last one, I think, is the one that is the most, you could call it scientific. And the most scientific, even though it applies to businesses that you can project properly a cash flow on your business. And I say it's the most scientific because you have a point of view that you can calculate backwards. I won't bore you with the details of the discounted cash flow, but the principle of the discounted cash flow is that cash is king, and a business that is generating cash in the bank or will be generating cash in the bank, the best way to value that business is to value the cash that business is generating in the bank. Because after all is said and done, it is the cash that is king. Now, there are businesses where this is relevant. There are businesses where it will not be relevant. Now, the second principle of discounted cash flow is that not only am I saying that cash is king and I will just value the cash. The other principle of discounted cash flow is that I will take future cash as being less valuable than present cash. In other words, a bird at hand is worth two in the bush. If somebody asks you today, take 30,000 naira today, or take 30,000 naira in 5 years, you prefer to take 30,000 naira today. In fact, somebody asks you, take 30,000 naira in 5 years or take 15,000 naira today. You probably still take 15,000 naira today. So that's the same principle of the counted cash flow, which is that money in the future, I have to discount it to know what it's worth to me today. So that 30K in the future, I will discount it by a certain amount and it will be worth 15K today. So if you see, and it's unfortunate I'm not able to draw on this as I had planned to, but I'll just summarize what I'm trying to say here. So the first line of the numbers is what you call EBITDA. EBITDA, to oversimplify it, is just essentially the operating profits. Not exactly because it's EBIT, but it's the profit on a business after you've sold revenues and paid your cost, your basic costs, right? So it is the money that you have generated after you've sold your products, done your sales, and then paid your cost. Just I'm simplifying it for that purpose. Now, after you've made your what you may call like your pre-operating profit, you then take away your capex. Capex is investments that I made in the business, like I bought motorcycles or I bought tables and chairs. You remove that because they're going to use cash to buy that. So you have this sort of pre-operating profits. That's cash every year. Each of those columns is a year. And then you take away your capex, how much you've invested, how much you spend on buying, you need to spend on buying tables and chairs and motorcycles. And then you also take away any operating expenses, any new operating expenses that capex is capital expenditure. Thank you very much. So, and then any operating expenses as well. The bottom line, what you're trying to do here is to figure out how much money is going to end up in the bank in that year. So if I have the money, I sold products, I paid my salaries, I paid my staff, I kind of have a pre-operating profit. I also spent money to buy these water dispensers or tables and chairs or motorcycles or computers or servers or data centers, depending on what business you are in, and sort of some basic working capital that I spent money on. How much is the balance that falls to the bottom that goes into the bank? Now, if you look at what I call transaction FCFF, that's just free cash flow. And that is the money that falls into the bank. And so in this example, these are numbers in US dollars. Just a sample of a business that I'm using. So the business is going to have $25,000 falling into the bank in $4,000 falling into the bank in year one, $25,000 falling into the bank in year two, etc. $30,000 in year three, $34,000 in year four. Now, that $34,000 in year four, if that is 4 years from now, so that money is not 34,000 naira today. It's not worth 34,000 naira to me today because there's uncertainty on it. I have to discount it. So there's something they call the WACC, weighted average cost of capital, and this is sort of the last thing I'll talk about. And that is a rate at which you discount future money backward. And the two startups that I'll be helping, I'll be walking them through this and helping them look at their business and doing this for them, so that they will understand it better and we can get on the value. So if you add up all the figures at the bottom of this transaction and free cash flow, transaction FCFF, if you add those numbers up, those figures are almost $600,000-$700,000 in total. All the numbers at the bottom. That's all the cash over the next 1, 2, 3, 4, 5, 6, 7 years. But I'm not going to value your business as $700,000 because most of that money is in the future. But there's a discounted, there's a weighted average cost of capital, which is like a discount number that you use to discount it. And the further afar it is, the more you discount it. So let's say that discount number is 15%. Then it means that 467,000 naira in year $407,000 in year 1, 2, 3, 4, 5, 6, 7, in year 7, that $467,000 in year 7 at the very right end, I will discount it 15% into year 6. Then I'll discount it 15% again for its value in year 5. Discount another 15% for its value in year 4. 15%, 15%, 15%. So by the time I come to this year, that money might now be worth $128,000 because I've discounted it over time to say that this is the value. That $467,000 in the future is worth $128,000 to me today. Now, that is exactly all that has happened for each of those cash flows in the future. That lands you at $378,000 as the value of the business today. And that's what you call the enterprise value. And so the $700,000 that all those numbers in the orange box sum up to is actually worth $378,000 today. Then you add any cash that you have today in the bank, because that one is real cash. You're not going to discount that one. That's money in the bank. So you can add it as its own value, which is $61,000 in this case. Then you take away any debt that you have because you're owing money. And the equity value becomes $423,000. That is the value of this particular business that we are looking at when you are going through the discounted cash flow. So just to summarize back what I said, you are essentially saying that I'm going to have a point of view as to how much money this business will be dropping in the bank, banked money, cash, every single year. I'm going to discount that amount for future years because it's not real money, it's a promise of money. So I'll discount it the same way that I'll discount 30K in 3 years to 15K today. And that will become the value of the business, the enterprise value. And then I'll add any real cash that I have that is not in the future, and I'll remove any debt. So if the value of the business is $423,000 and somebody now says I have 100K to give you, then the person will get a little less than 25% of the business because it will be $100,000 over 423. I hope this makes sense. Now let me just go on the very last slide. Last slide, just skip the whiteboard for now. Some things can change your valuation, like if you decide to promise a price with a preferred return. But I just have a few things to share with you before we close this session. The first point is that before you get into arguing about valuation of your business, spend your time building something that is actually of value, something that makes sense, that will make real money. Otherwise, you're going to get found out. And you might get lucky the first time, second time, but you will not build a sustainable business. And I'm saying this to say that change your business if you are not sure that it's going to be making real money. Pivot it. Switch the model. Modify it. Maybe you're doing logistics with motorcycles. Change it. Start doing, or you're doing logistics, delivering food. Change it. Maybe start delivering more than food. Or, add, boats to it. Or, go pivot to focusing on one city in the cities versus covering all of Lagos. Change it. Keep changing your business model to where you start to add real value. And then choose investors as much as they choose you. Don't be shy as an entrepreneur to turn down money. Now, I'm saying this obviously knowing that we're in a hard environment where money is hard to find. But if you get into a deal that makes you feel bitter or makes you feel like you got a bad deal, you will spend your energy trying to get out of a bad deal. And even at some point, you might decide that it's not even worth building your enterprise for somebody else. But remember that it's still your vision and it's still your life. And you've left a lot of things on the table. So get more than money. Sometimes if you have an investor and one is giving you money and one is giving you a network or connections to markets or connections to legal advice or to structured advice, some of the things like Innovation Center is doing, take those people's money. Don't just take the money of that uncle that's throwing money at you without any real value, if they are offering the same amount of money or the same valuation. And then finally, I'll say get help. Get help. Because this lecture is oversimplified. This is very, very simplified for what valuation really is. But I hope it's at least able to give you a little bit of the basics on how valuation works. And I hope that you can then be able to, from there, think about how to think about your business, how to price your business, how to get in the minds of an investor, and how to you yourself land on what you think your business is worth. So that when an investor approaches you, you can have a right negotiation on what percentage they should take in your business for the amount of money that they are giving to you. Thank you very much. I know this was a very rushed session. I wish I can do this for 3 hours and go into a lot more detail and take my time. But I hope that this has been able to help you a little bit. Thanks a lot.
Uzoma, can you hear me?
Yes.
Okay. Now, big apologies. My internet is failing, so I keep.
Uh-oh. Doja, we stopped sharing you.
Yes. Okay.
Hello?
Okay.
Victor,
Yes, go.
take
We
over.
can hear
Take
you.
over.
We can hear you.
No, I think you should take over because I think it will go off any second again. So please take over.
Okay, thank you, everyone. Thank you, Mr. Uzoma Wagba. Thank you for that insightful session. And I hope very soon we'll still bring you back because you've done a lot of justice, but we believe that there's much more to it that we need to get from you. So very soon, I hope we'll bring you back. So thank you, everyone, for staying in tune. So now we'll take questions and allow Mr. Wagba to answer some of those questions. So there's a question from Itel Telecoms. Okay, pardon me, please. He said, I think you are still talking about paying customers. Your product is ready. It has been validated, but yet to make a single dime. How do you negotiate with an investor? Let me take it again. I think you are still talking about paying customers. Your product is ready.
I heard it.
Okay, great. Yeah. Can you speak to that, please?
Yes. Yes. Victor or Doja, do you want to take a couple questions and then I answer, or do you want me to answer one by one?
One by one will be good, so that we don't model everything up.
Okay, no problem. So if you don't have paying customers, that is fine as well. In fact, a lot of businesses start off raising money without having paying customers. And so what you are valuing at that point is not just the idea, but the execution. So let me say it in simpler terms. There are a number of phases of a business. And what an investor thinks about is risk. Bear in mind that when an investor wakes up, goes to bed, the thing that they are worrying about is risk. Forget the suits, forget the checks they're signing. The real thing that is on their mind is risk. So the reason why you should think about that is that when a business goes from phase 1 to phase 2 to phase 3 to phase 4, it is reducing its risk of success. It's a bit like a child, especially in an environment where there's high infant mortality, where a lot of kids die at birth, which is really how business is, especially in our environment here. When a child is born, the risk of that child surviving is risk of that child dying, is low. I mean, it's high. The risk of the child dying is very high when they are born. In an environment where infant mortality is high, where the environment is toxic, there's a lot of disease, there's not a lot of hygiene, the child will die, is more likely to die when they are born. If they make it through the first month, and the second month, and the first year, and the second year, and the fourth year, and the 10th year, their chance of dying is a lot less. And so an investor is more comfortable and values the child more when the child is 10 years old than when the child is a baby. But it doesn't mean that an investor will not look at the child now and project their future and say, you know what, this child, I will still invest in them because I believe they have a bright future. But it's just that it is not yet proven all the way. They're not necessarily going to school, you know that they're doing well in school, etc. I'm using that analogy to talk about your business because I think it's probably most relatable. When you are starting a business, there are phases. There's the idea. There is the putting together the team. There is the fleshing out the idea into a strategy. There is executing the strategy, building the products. There is setting up your supply chain to sell it. There is marketing. There is now the thing in the field. Then there's paying customers, and then there's scaling the business. So people just call it as sort of the early stage, the growth stage, the scaling stage. And you find out that the further along you are in your business, the more valuable it is, the more value the investor will ascribe to it. But if you're in the early stage, it doesn't stop you from having a projection. You project that, which is what we did even in that discounted cash flow I showed you. Those numbers, the business that we did that for, those were not, they had a point of view of how many customers, back to the tech startup example, I'm going to have 5,000 customers in year one, 10,000 in year two, year three, I'll scale up to 20,000 because I'll start doing marketing. And year four is going to scroll a little bit. Slow down a little bit. So based on that, you have a point of view. And you can even do your discounted cash flow based on that and land on the value of the business today. You don't have to have active customers or paying customers. But obviously, it's more believable and the value can be higher according to your investor if you have proven the model and you are selling the product and people are buying it.
Okay, thank you, Zuma. We also have another question from Adetomi Odufuye, which says a DC evaluation looks at the present value of free cash flow by discounting the enterprise value. Well, it's a long one. Enterprise value with the weighted average cost of capital after making an assumption for group based on 3 to 4 years performance. Which valuation is most popular for investors? The multiple approach seems to make a lot of assumptions and seems to be very subjective. It's a long one actually. Can you attempt that, please?
Yes. So there are actually many more, well, not many, maybe 5 or 6 so more valuation methodologies. So the 3 I showed you are generally the 3 most popular that investors use. Now, within those 3, it's a bit difficult for me to say that one in particular is the most popular of the 3, but I know that 3 of them are at the top. The reason for that is that the choice of the valuation method you use varies by industry and by the stage of business. For example, I wouldn't be able to use multiples analysis on a business that has not started, because the multiples, I'm comparing the multiples, unless I'm using forward multiples, which is possible as well, but it's not as credible as making multiples on the business that currently has sales or currently has cash or currently has profits. In which case, I'm looking at another business that has sales, has cash, has profits, and has raised money. I'm looking at the multiple at which that money was raised, and I'm applying that multiple to the sales or cash or profit of my current business. So a business that is at least very early stages, you probably won't find a lot of multiple analysis on them unless you're using forward multiples. So you now start looking at free cash flow for a business like that. And even then, it's better when the business already has existing cash, that makes it a bit more credible. Where you find these days a lot of, at some points, because valuation is such a difficult thing to come to an objective truth. So there's quite a bit of subjectivity in it, but you can get directionally correct. You can get close enough to the truth. So you find that a lot of businesses, because they can't quite land on objective truth, and then free cash flows or discounted cash flows is not an easy way of valuing a business because it's still very much on projections. They get into the VC method where the investor just comes and says, you know what, I want X percent of the business and I'm going to give you the 30 million naira that you're looking for. I want 20% of the business or 30% of the business, I'm going to give you 30 million naira you're looking for. And then you say, haba, no, the value of this, my business is worth more than that. I can give you I can take your 30 million for 15%. But even you having that sense of what the value is, you have to do a little bit of work on analyzing the business. You look at comparables possibly, or you do a discounted cash flow. I personally prefer the discounted cash flow method because it's a bit more scientific, and it puts me in a range that I can kind of wrap my head around and say, okay, you know what? This is worth $300,000 because I have done it, I have done the math, and I've kind of discounted it, and it makes sense. So I would look at a range of $250,000 to $400,000. If anybody meets me in that range, I'm happy to do business with them. I'm happy to sell a piece of my company at that valuation. So I personally have a preference for things that are a bit more scientific and empirical, but it doesn't take away that there's still a gut feel and an art to it.
But most people kind of take the lazy approach of getting into a negotiation and landing on the figure. But for you to do it well as a startup yourself or company yourself, you need to do a bit of DCF or other methodologies to even know where to start to have your negotiation from. Does that make sense?
Okay, thank you, Zoma. There are several questions here, but I'm not sure we'll be able to answer them. If not, we'll be here till the rest of the day. So we'll just take two or three. We'll take two or three more. And of course, there are a lot of our colleagues saying a lot of. However, the two questions. One of the questions is from Samuel Ade Adonreke. He said, "What valuation do you give to a knowledge transfer?" And while you're answering that, we are going to launch a poll now. So, but let me repeat the question again. What valuation do you give to a knowledge-based business or knowledge transfer? Thank you. So,
what valuation do I give to a knowledge-based business or a knowledge transfer?
Knowledge transfer, yes.
The principles are not different, to be honest. The principles are not different depending on regardless of the business or the type of business that you are in. Because what happens is that if you are saying knowledge transfer, I guess you're talking about intellectual property. And for the example that I gave you of a business that I looked at that had a genome sequencing, essentially, that will take your DNA and predict your susceptibility to sicknesses, your likelihood of having cancer or diabetes, so that you can start treating it when you are young, or start making lifestyle changes that allow you to survive it more easily. Now, for that kind of business, you are still going to go back to the fundamentals, which is you are valuing the business because somebody is trying to make money. Somebody is trying to give you money and is trying to return their capital. So to do that, you and that party would still end up figuring out how many people are going to use this intellectual property or the product that comes out of this intellectual property. How many people are going to use that product to better their lives? How many people are going to buy these tests or these kits to better their lives? So you can't really, intellectual property only comes useful in the context of a business or context of an application of that property. So it's only when it enters a business that it becomes something to value. Otherwise, it's just intellectual property, just an idea, and that's fine too. But for you to get money paid for it, somebody has to be making money from it. And so the same principles of looking at similar industries, let's say the biotech industry, and who has invested in them before and what multiples were used to value those businesses, or going to the person trying to buy your intellectual property from you and negotiating a percentage for the amount of money you're trying to get, or discounting how much cash would come in from that intellectual property to that person. Each of those methodologies still stays the same. Did you hear me?
Okay, thank you. I said before I asked the last question, a lot of people are requesting for your contact, but I know that you are a very busy man, so we might not be able to give out your number, but can we give out your email?
No. My contact is on the next slide. Sorry, my contact is on the next slide. Sorry, please project.
Okay.
Just move to the next slide. Yeah.
Okay.
Yeah, that's my contact.
Okay, thank you. So I'll ask the final questions now. Which is that from your experience, how do tech VCs in Nigeria think about IRR and exit multiples? Do I repeat that?
Okay, very, very good question. Tech VCs, I think to understand it, maybe I'll go one step even further and ask, how do the people that give them money, because a tech VC is a company probably in Nigeria or owned by a Nigerian, or maybe a branch of an international company that is raising a lot of capital, most times foreign capital. So they're raising money from foreigners, they're raising money from family offices, they're raising money from other private equity firms, they're raising money from high net worth individuals in many other countries. So for you to understand how they think about IRR or multiples, you want to understand what they promised the people that are giving them the money to come and invest. Because remember that the VC, their job is essentially to just take money from wherever, from an outsider, promise them something. For example, I'll return 3 times your money in 5 years. And 3 times money in 5 years is it's usually about 30% IRR. That means that your money will grow 30% every year. And that means in 5 years, it would have grown into 3 times what it was at the beginning. So there are those promises that the VCs make to their sources of capital that allows those people to give them money to come and look for your business to invest in. That is how they think about IRR and multiples. And typically, how do those people abroad, or the people that give them money, they don't have to be foreigners, but they might actually be high net worth individuals even in Nigeria, or investment houses in Nigeria as well. How do those people think about investment? They think about investment from a perspective of alternatives. If I am a private equity fund or a fund of funds in New York City, and I am trying to put money in Future Africa, that's a VC in Nigeria, and I have $10 million, and Future Africa says, give me $5 million to put in my fund. I'll go and find businesses in Nigeria to invest in, and I will return your money. What the VC in New York City will be asking is, should I put my $5 million in Nigeria, or should I put it in Brazil? Or should I put it in Kuwait? Or should I put it in Malta? Or should I just hold it in my New York? At least I can walk to the office of the business and see what they're doing with my money. To decide to put it in Nigeria, they have to be giving him more returns than all these other places. In a believable way, he has to believe that after I consider all the things in Nigeria, including the macro environment, including the difficulty in the business environment, including the FX issues, I can still make more money than if I had put it in the business next door to me in New York. So if your VCs here, promise them, make them those promises in a sort of realistic fashion, sometimes unrealistic. But usually that ends up being that they'll say, I'll give you 30% return every year, or I'll multiply your money by 3 times in 5 years. Some will say, you know what, I'm going to get you a unicorn and your money is going to grow 20 times in 5 years. It just depends on the conversation that is had. But that's why I said that the first thing to do is when I say think like a man or think like a woman, when I was talking about relationships, the same thing applies to VCs. Try to get in the head of the investor. Try to get in the head of the person giving them money. Sometimes you won't ask the person, your investor, where's your money coming from and what are your pressures, so that you can understand where they are coming from. And I think that would help you to make the right decision as well.
Okay, thank you so much. And thank you, everyone. We have come to the end of today's session, and the presentation will be available on our website. That is www.ecoicenter.com/webinar. And by tomorrow, the video will be ready, so we can go there and download. And if there's any question, the contact is available. It's there on our screen, so we can freely contact him, and you give us, you do the right thing. So like I said earlier, we are still going to bring Mr. Uwagba to this place, because we believe that this is not something we can iron out in a single session. So very soon he's going to come back. Just stay tuned, and thank you, everybody. God bless you. Bye. Thank you, Zoma.
Thanks, everyone. Thanks so much. Have a good evening.